Theodore Shou, welcome back to the program.
Thank you for having me.
So first and foremost, why did so many top investment banks, buy into Archegos and its founder Bill Huang in such a big way? I mean, it's probably not a stretch to say that he's a disgraced former fund manager, no longer welcome on Wall Street or on the Hong Kong stock exchanges. So why, support them in this way?
I think in short, it's all money driven. It's the financial incentives behind dealing with an individual like this. I mean, a lot of the jurisdictions have separate regulations around commercial banks, or normally banks. Particularly if we look at China, all the subsectors within financial services are strictly separated. Whereas in certain other markets, you see highly integrated financial service providers like these investment banks. So on one hand, they perform as a normal bank, but on the other hand, they perform as a broker, stockbroker. And in this specific case, they are more than stockbroker. They are what we usually refer to as prime broker. So the prime brokers, they do offer the average service of stock dealing. They do provide leverage in the forms of loans, but they also help your clients to structure different complex notes or structured products. The profit margin, however, across these different services are very different. The normal average stock dealing is the day-to-day routine, whereas the high leverage, the complex products provide a lot more profits to these banks. So ultimately, it is the financial incentive that's driving them.
Now, Archegos is what's described as a family office. It sounds a bit like something you'd have at home. But what is it in finance speak? Because I understand you actually used to work at one.
True. So in the conventional definition, family offices refer to how a wealthy family set up a particular entity to arrange for all different aspects of their family. So it goes far beyond just investment. Normally, the functions include investment, estate planning, and even charity. But if we look at US, or specifically within the asset management industry, I think family office could also be referred to very narrowly as what I'll call a retired hedge fund manager shelter. Very often you see hedge funds, particularly high-profile hedge fund manager, might be violating certain rules, and then they will reach a settlement with SEC. Normally, part of the settlement will include no longer managing external money, but they can still manage their own money. So then these hedge fund managers will just take a step back, say, okay, I will manage my own money in the form of family office. So in that particular context, family office specifically refer to the investment vehicle these people use.
Now, doesn't that make it a bit misleading then? Because, it sounds relatively harmless, but these generally serve ultra high net worth individuals. So isn't there a risk of them having an outsized effect on the markets, as I suppose they have in this case?
I do think so, and more apparently we are seeing increasing a number of cases like this. But in the past, I think the essence of any financial regulation is centered around protecting investors and protecting maybe even retail investors per se. So they didn't really spend much time on how to formulate a framework to regulate these large investors. If we use casino as an example, normally across any country, operating a casino is a highly regulated business, but there's hardly any regulation governing gamblers. But in this particular case, what we have is a few high-stake gamblers who have so much stakes on the table that can break the house, which will make the house unable to meet its own obligation to other gamblers. This is exactly when a systematic risk arises. And you're right, I think nowadays regulators should also update themselves to adapt to this new environment to be facing these high-stake gamblers and learn how to govern them or regulate them.
Now, you know, we've sort of gone over the fact that they do have limited oversight, but there are more and more of these family offices around the world. Ernst & Young says that there are more of these companies globally than there are traditional private equity and venture capital companies, and that they manage more than $6 trillion in total. Now that sounds pretty huge. How much of this happens here in China though, and how are they regulated here?
First of all, family office is such an abstract term or concept, and there's no unanimous definition of family office. So we usually see data providers like Ernst & Young in this case, who can use different gauges to measure how large the market is or how many family offices there are. But as I said, there's no specific definition of family office. And in China, what we see a lot is many wealth managers are trying to sugarcoat their high-end solution to the investors as family office, which is not necessarily true, but it's not technically wrong either. And therefore, if we look at China, I would say there are many, many different types of family offices. And there are also actual first generation of entrepreneurs who have made a lot of money, who are setting up proper family offices to manage their wealth and to learn how to pass on the wealth to future generations. And there are many of these entrepreneurs who set up family offices both onshore and offshore. Let's
look at the fallout now, because several of these companies that have been caught up in this are listed Chinese firms in the US, and Archegos had some very heavy investments in those. I mean, Tencent Music Entertainment, VipShop, GSX, Baidu, Farfetch. There was a list of really big names there, and a few of them have been announcing share buybacks. How do we read their moves there?
Usually share buybacks is a good signal to the market, showing the market that the board of directors, the senior management, has full confidence in the company, and they believe the company is currently undervalued. That's why it makes sense for the company to use its own treasury to buy the shares, because these shares are cheaper than what they believe. So as I said, it's a good signal. But to some of these, particularly tech firms, it's not necessarily the best thing to do at this stage, because across that list that you just mentioned, some of the companies are really in good shape. They are cash generating, they are sitting on a large pile of cash, and probably buying their own shares is a better thing to do than investing in something more adventurous. But some of the others, however, are cash hungry. They actually need to go to the capital markets to raise capital. And what's the point of spending more on share buybacks now? I mean, I fully appreciate this signal that they are trying to show to the market, but there's a fine balance on whether it is worthwhile, whether it is sensible.
Are there other ways to send that signal?
I think there are many other ways, because honestly, tanking in your share price due to someone deleveraging is not directly related to the company at all. I mean, the overall market shouldn't be perceiving the company as in a negative position. In fact, if we believe the market is functioning, then such oversold or overbought situations will be self-corrected in the market in the following weeks, if not quarters.
Theodore Shou, thanks as always for joining us.
My pleasure.